Good evening, everyone. Welcome to the quarterly call. We're having this after about three and a half months. The last call that we had was very number focused. We went into a lot of details because there was a big fall in the markets, and we wanted to cover a lot of data. In this call, we will specifically talk about a big trend that we have seen over the last few quarters, and which has only gotten accentuated post-COVID. So we'll spend a lot of time on that call, and the remaining time we will go with Q&A. So with that, I'll pass the baton to Manoj to talk about how he would like to structure his opening remarks, and we'll go from there. Manoj, over to you.
Yes, Ram, thanks. So I will prefer to speak a little freely, and so that my thoughts do not get disturbed. So while you have put in a PPT there, I will take a cue from that, but I will prefer, speaking the way it comes to me rather than looking at the slides. So, so good afternoon, good evening, everyone. A lot of things to talk about, and early disclaimer would be that do not look at my address as a politician trying to lecture someone on the India story, but this is what we as analysts deeply believe in, and that is what we are sharing. So India is now in a phase where it is transitioning from what happens in the world influences India to what happens in India influences the world. We are in that phase. We are not yet there, but this is the journey that we are traversing. Because those of you who've been investors over the last 2-3 decades would relate to me when I say that there was a time when Indian markets would be completely driven by FII movement. Okay, any trader, the first thing who would get up, those were the early CNBC days. That was the only channel which used to air stock market related data, and that too not for full day, just about 2 hours in the morning and 2 hours in the evening. So those days, a trader gets up, first thing he checks is what happened to Nasdaq while he was sleeping, because that would determine the trend of markets in India. Now, as time passed, maybe the key indicator moved from Nasdaq or DJI to SGX Nifty. The first thing that we would check is, okay, how is the SGX Nifty doing? Now, because 2 hours later, when our markets start, it is essentially driven by the movement of SGX Nifty. So all our early trades would be driven by what happened elsewhere and not necessarily within India. Despite all these challenges, India has surged ahead and is now a force to reckon with. For many analysts, we may still be non-Japan Asia. They do not feel that India merits a separate coverage, or maybe just emerging economy. But there is no denying the fact that India will not only chart its own path, but influence the choices of other nations and the direction of global market. As things stand today, India is pulled along the rest of the world due to persistent global developments. Yet it stands apart as a paradox, one that refuses to toe the line, clearly determined to not just unshackle itself, but over the next decade, lead the world out of its difficult economic situation. Let us take a look at some numbers in the post-pandemic scenario. Ram, do you want to put up that slide? That one slide where the numbers are there?
Yes. I'm just bringing the share back. Just give me a minute. You can continue speaking, Manoj.
Yeah. So we will just look at a few numbers, although I do not want today's call to be numbers driven like it was earlier, but numbers do help in understanding the scenario. So here is a look at, okay, right, thanks. So here is a small table which essentially gives us three numbers for each of the geographies that are listed. The largest economy of the world, the United States of America, grew at a 5.7% growth rate in 2021, which slumped to 1.6% or is expected to slump 1.6% in the current year, and is currently facing an almost unprecedented situation of a 7.9% inflation. The second largest economy, China, the originator of the Wuhan virus, decently performed in 2021, grew at 8.1%, but has since then been paying the price for its own deeds. Growth rates have slumped to 3.5%. Japan, the third largest economy, has been in a near recession state for many years now, and its growth rates are anything but impressive. The Eurozone is having its own set of challenges. And now look at our country. Why do I say that India will lead the world and influence the growth, etc.? India grew at a rate of 8.3%. It was the fastest growing economy in a year half impacted by COVID, including the most difficult second wave phase for the country. And it is estimated to be the second largest growth story for the current year after Malaysia. This is in spite of persistent high inflation. So if we look at what is happening today, I do not want to go into the other economies, Russia, Brazil, etc. Maybe we'll talk about them. But if we look at what is happening today, we seem to be getting dragged down because of global factors. The macro indicators of India in isolation may not look very convincing if we take the numbers as is now, as we can see now, at a point in time number. There is a persistent fear of markets slipping down. Investors are clearly worried that they may lose hard-earned capital. And there are two global factors that is having a significant impact on our economy and our market. The first one, as we fashionably like to call as the geopolitical situation, or in simple terms, the Russia-Ukraine war. Firstly, people did not expect that the war will actually happen. When the war did get started, we thought it will get called off in a few days. And yes, we know that the war cannot go on forever, but it's been more than 6 months now. And in the coming few days, the war is expected to escalate. As things stand today, we've not seen too much of an impact of sanctions on the Russian economy. It's just about 4% negative growth. And Russia currently has a current account surplus. But like any economy that's in a state of war, it has been suffering very high inflation. And that will only worsen as the war continues. And this will have an impact everywhere. Russia is among the largest exporters of oil. And this scenario, coupled with sanctions, has resulted in oil prices surging. Although we've seen correction in the oil prices, again the likely escalation in war and the strategy of the European nations in terms of how they'll handle this to put pressure on Russia, it is likely that oil prices will go up further. Then perhaps a bigger issue that is currently impacting the markets and our economy is the US economy, the largest economy of the world. The US has been facing some very tough times, not because of growth really, but because of inflation. At one point in time, the inflation rate was the highest in 40 years. Now, this is very, very paradoxical. I might have said in one of our earlier con calls that the US doesn't really experience inflation. So why do we say that? And I will have to take a little bit of class on macroeconomics so that we understand what the situation is and why it is different and how it is impacting everybody. So the US dollar is the most powerful currency in the world. Unlike India or any other country, if we print money, our currency loses purchasing power. But this does not apply to the US. The US can simply print money and buy whatever it wants from anywhere in the world. This is because every other person, every country is happy to accept the US dollar. And therefore, the US dollar does not lose purchasing power. And hence, you do not really face inflation because the US will source whatever it wants from wherever it is available in the rest of the world. It doesn't really have to produce that. It can simply buy without any loss of purchasing power because everybody is happy to accept the US dollar. So why is the US inflation surging like it has never before? This is because of the continued and large inflow of money into the economy. See, since 2000, if we observe not just the Federal Reserve, almost all central banks, and I would say India is an exception to this, but typically countries or central banks have followed the mantra that if there is any crisis, the way out of that crisis is by simply putting more money in the hands of people. And as I said earlier, this resulted in other currencies losing purchasing power, but the US was not impacted. And we can see this clearly in the way other currencies have depreciated against the US dollar. However, this mantra is now failing to work simply because the world cannot produce at the same pace as the printing of currency. Every country is happily creating new money, but this is not matched by production. For a country like India, it is about domestic production. For a country like US, it is global production. Anywhere in the world, anything is available, the US can pick it up without losing purchasing power. But if the item is simply not available, then the price will eventually go up. So the demand fueled by easy money is now not being met even with global supplies. Typically, when you have easy money or low cost money, interest rates are reduced, liquidity is abundant, loans are easily available. This is expected to help businesses to expand. New entrepreneurs get encouraged to try out their ideas because funding is available. However, if I can earn the same amount of profits by simply investing the money in my hand in secondary markets, then why would I want to slog 24 hours a day trying to build an enterprise, managing people, doing so many things, taking headaches, paying taxes? Because end of the day, as a business person, as an entrepreneur, I want to earn profits. And if these profits can come simply by buying and selling either shares or indices or currency or commodity or whatever in the secondary markets, then there is very less incentive for real growth. A person who is having access to money today doesn't wish to put that money in real economy, but in markets, and thereby earn the same amount of money. So what happened is that the increase in liquidity did not bolster the supply side with money going into financial markets. But the fact of life is that we need real things. We need food, we need water, we need clothes, we need TV, we need vehicle, we need air conditioner, we need laptop. Money is only a medium of exchange. So it helps us in transacting, but money in its own cannot meet our requirements. So if the supply side does not match up, it will eventually result in inflation. And as the cost of living goes up, workers demand more wages. And this results in increase in cost of production of whatever these workers are producing, which leads to increase in prices of the product, which again leads to cost of living going up. And the vicious circle continues. So how do we resolve this problem of inflation? So again, whether you say economics wise or mathematics wise, there are only two ways to tame inflation. Either increase supply or cut down demand. The only way inflation can be tamed or controlled is by ensuring increase in supplies or by cutting down demand. What the US has done is that it has chosen the latter. It has chosen to cut down the demand simply because the former is not possible. You do not have the option of increasing in supply. Increase in supply needs resources, and we are happily consuming our resources without worrying about anything, as if there is no tomorrow. So what the US has done is it has taken recourse to the monetary policy. The same policy with which it pushed money into the hands of people is now being used to pull money out of their hands. So interest rates have been pushed higher. What this does is that it increases the financing cost. Not only does it discourage people from starting new enterprises or expanding, but it also increases the financing costs of existing companies. This again makes it difficult for smaller companies. Their cost of production goes up. Some companies get closed down. There are production cuts and there is slower growth. What consumers do is that they try and manage their demand. Okay, there is either cut or a shift in consumer spending. For example, if I drive down to my office, I will see if I can use public transport. Instead of dining out, I'll see if I can have meals at home. I look for cheaper alternatives. And maybe I'll buy products which are priced lower, which have been imported from places like India. As a US consumer, I'm talking about. Now, as consumers tend to contain demand, the fall in demand pulls down growth. And this results in what we again fear as recession. So already there are talks of recession. the Euro, UK, China, US are all flirting with recession. Now, we do not say that they are already into recession because of the technical definition of recession. The technical definition says 2 quarters of negative growth. So we've not had that. So we do not yet call it recession. But economists and analysts are of the opinion that we are heading towards that, and the probability of a recession is now much higher than what it was maybe 2 quarters earlier. Now, what happens when there is talk of recession is that everybody becomes conservative. Just like the consumers cut down on their demand, they try to shift their preferences, etc. Similarly, an investor will shift the investment to more safer assets. Your ability and willingness to take risks reduces. Your appetite comes down. And this is again reflected in the market by way of lower prices. Now, what is also happening is that increase in interest rates in the US is resulting in US dollar appreciation. Please understand, this is one of the paradoxes. An economy which is experiencing unprecedented inflation, meaning loss of purchasing power, should actually depreciate. It should depreciate either against other currencies or against the ultimate currency, that is gold. But what do we see? We see that the US dollar is appreciating against all currencies. Excuse me. And it is, the gold prices are also not going up. Typically, this should have resulted in a huge rally in gold. But we are not seeing that also. The US dollar is appreciating. Now, what this does is, this makes US goods expensive. For a US consumer, imports become cheaper. So there is a shift in buying, as I said earlier, to products that are actually imported and not locally produced. This will again negatively impact the domestic industry. Profits of US companies will reduce. As their profits come down, their stock prices in the US markets also will fall. And for a US investor, any investment outside the US will now earn lower return. Why? Because the dollar has appreciated. So the immediate reaction is the foreign institutional investors or the US based investors pull back money into the US. They're happier investing it in a treasury bond rather than keeping the money invested in a country like India. So this will impact our economy, our markets, which are in need of capital. The only silver lining in this entire episode is that, fortunately, unlike the 2008 situation, US households do not have very large debt. Business balance sheets are also healthy. And therefore, we are unlikely to see a financial stress resulting in a global financial crisis kind of a situation. What we will see is supply side adjustments. Now, supply needs to increase. Either it should increase by way of increase in domestic production in the US or imports from countries like India. And then shift in consumer spending. Discretionary expenses such as, say, travel, holiday, etc. will get cut down. Suppliers who keep costs low will benefit. So this is what is happening in the US. So very, very different from what the scenario was in US earlier. Now, having understood this, let us now look at India. Now, yesterday RBI announced its latest policy, which was an increase in repo rate. Now our repo rate has gone up to 5.9%. Now again, This should be bad news for the markets, but we've seen Sensex going up by, I think, more than 1,000 points. Now, why is the RBI increasing interest rates? Because the same logic that I explained to you of US applies to India also. If you are increasing your interest rates, that means cost of financing will be higher, funds availability will be difficult, businesses will not be encouraged to set up new ventures or expand. Consumers will feel that instead of spending money, let me put it in a fixed deposit because now I'm getting 0.5% extra. And with both consumption and investment going down, this is bad news for growth of economy. But we have the markets going up by 1,000 points. Why was this rising rate important? Very simple. The US is increasing its interest rates, and that is causing a clear depreciation of the rupee. Now, let me hasten to add here, a depreciation in rupee is not something which is like, izzat ka sawal for the country. We are not losing face. India is not getting insulted, or India will not be looked down upon because its currency is depreciating. In fact, currency appreciation is a problem, as we understood. Depreciation of currency is perfectly fine. But what happens with the depreciation of currency for a country like India is that one, your imports become expensive. Okay, and the ability of the country to attract foreign investment suffers. So if we want the foreign investment to stay in India, then it should be attractive enough. And therefore, we will have to match the increase in interest rates in the US with increase in interest rates here. Otherwise, the outflow of capital will continue. Our other numbers also, as I told you, if you just take a point in time numbers and say, okay, what are the macros for India today? They're not impressive. As we saw, inflation is again inching up to 7% levels. For a brief period, it had come down, but now again it is increasing. Food inflation is going up. Our current account deficit is now almost 2.7% of GDP, which is very high. And then unemployment is also increasing. And as I told you, currency is depreciating. So if you look at the macros of India in isolation, doesn't look very great. Yet, in spite of the above, we are the fastest growing economy. You see economic activity all around. You see a lot of construction going on. Walk into any mall today and you will see that there's hardly any place to stand. Consumer confidence numbers are at a high. Business confidence and manufacturing PMI is holding ground. Companies have reported improved results despite input cost pressures. So in spite of operating profit margins going down because of increase in material costs or labor costs, we're still seeing high revenue numbers and increase in profits. Today's India is more aspirational. We are no longer satisfied with what we have. There's a burning desire to achieve more. This may or may not be desirable from a societal point of view, but from an economic standpoint, the youth today is willing to do what it takes to get what it wants. Higher risks are being taken. And thus, the long-term India growth story is not only intact, but it is actually strengthening. However, we must remember that the single largest driver of markets is liquidity. Markets do not change once in a quarter. Markets change every second. And if there is any factor that can be held accountable for a change in markets every second, it is liquidity. So liquidity is the prime driver of markets. And currently, the liquidity situation is not very favorable. This means lot of bumps in the short run. The traders will have a field day. With lot of volatility in prices, they are bound to have a rush in adrenaline and they will enjoy this journey. Some will win, some will lose based on what kind of bets they take. And we will not know who will win and who will lose. But in case of investors, we know that those who sit tight will win and those who panic will lose. I think I will stop here. Ram, I think I have exceeded the time that you had allocated for me, but I thought I should convey this. So we can now either go for Q&A, or if there's anything that I've missed out, you can. Ram, I can't hear you. I think you're on mute.
Manoj, can you hear me now?
Yes, I can.
So the slides we had on how India has performed versus the emerging markets and the US market, I'll just run through them. You may want to just comment on those. Challenge here today. Fine. That's okay.
It, yeah. So
yeah, you already covered it. So we can straight away go for the questions that some people have asked. Okay. Let me just, anyway, I got the hand on the slide. I'll just open it up. This is the slide I was talking about, which talks about India versus emerging markets. Clearly, we can see that India has slowly but steadily moving, it's breaking away from the other emerging market pack. Manoj already talked about how what holds in the future for China. Russia is already under its own unique situation. So this is one interesting picture. The second picture is India versus the world, excluding USA. There's another chart which I couldn't put it on time, but which compares the Nifty index with the Nasdaq index. And over the last 5 years, Nifty Nasdaq ratio has been in a range. It's been bound to a range. 5 years back, there was a steady and quick increase, but it's been range bound, and now looks like this is likely to break away from that. So that's the other interesting thing. Nasdaq has obviously, as you can see, Nasdaq has touched the June lows, and whether you call it a double bottom or whatever, I don't understand technicals that much, but it's poised interestingly, and it could fall further by 10, 15, 20% is what some experts are saying. I don't have a personal view on that. But year to date, if you see, Nasdaq is down 31%, S&P down 23%, Dow is down nearly 20%, and Nifty is down only 1.5%. So that summarizes how India has performed versus the other markets. There were some questions on how our portfolios have performed. So I'll put up those slides and then go to the questions that people already listed. If anybody has any other question, they can always open it up in the chat window. So we launched the Jewel portfolio in August 2019. Since then, till 29th, till Thursday, the portfolio has given a 27. The model portfolio has given a 27% per annum return. I know the last 1 year has been very tough. So clients who entered in the last 1 year would probably see a negative growth. And the markets have been pretty tough over the last 9 months to 12 months. But over the pre-COVID, post-COVID, etc., the portfolio has done well. The second portfolio that we have is the Spar portfolio, which is a purely small cap portfolio. And since launch till Friday, this portfolio has returned 24% CAGR versus BSE at 15% CAGR. Now, we did do a rebalancing in earlier in September, and since rebalancing, Jewel is down by 2.5%, whereas Nifty is down by about 3%. This is the numbers. As far as Spark is concerned, Spark is actually slightly up since rebalancing, which is in the last 4-5 weeks. We are at 4:38. I'll now move to some questions that people have asked. I'll start with sharing. So there was one question by Mr. Reddy. Is it a right time to get into real estate? And what is the growth forecast on the Jewel and Spark portfolios? Manoj, do you want to take that, or should I pitch in?
You can go ahead, Ram.
All right. Real estate asset allocation is very important. So if you don't have any real estate, obviously some real estate is good. But personally, I am personally putting one of my apartments on sale and trimming my real estate exposure. That's a personal call. The reason why I believe that exiting real estate is good now is because the next few months will give us good opportunities to buy. Like Manoj said earlier, the road will be bumpy ahead. So you have to fasten your seatbelts, and wherever there is an opportunity to buy, it's a great time to invest. Real estate over 10-15 years, the CAGR compared to the Nifty index is much lower. We can share some data and maybe in the next call or mail it across in the deck. The quality stocks, if you keep and hold them with regular rebalancing, that portfolio has proven to give much higher returns than real estate. That's the short answer. The growth forecast on Jewel and Spark, it is optimistic. See, we personally hold a significant chunk of our own net worth in these two portfolios. So we have that optimism and confidence that the portfolio will do well. Yeah, but the road will be bumpy, so this is the time to stay invested. The other question is, Jamā benchmark versus peers. I've already shared the data. The last question he's asking is it a right time to invest in Nasdaq and in international stocks? So Manoj, I will put that to you because you've covered a lot about international markets in the earlier part of the conversation.
Yeah, okay. So again, there is no straight answer to any question because investing is again about asset allocation and everybody's asset allocation is different. So we've advised earlier to take exposure to international stocks as a diversification measure. However, if you are specifically asking that should you be investing now, I would say the growth prospects are much higher in India. Okay, so if you have additional money, then keep pumping it up in the Indian markets. For a US investor, they will calculate dollar denominated returns, etc. And returns, if they are 18% in rupee terms, maybe they are 11% in dollar terms. But otherwise, for an Indian investor, as of now, Indian stocks are the best bet.
Yeah. So I'll move to the next question, which came on email from Naveen. His question is on AI and ML. Why could we not predict that Manappuram will languish? Why could we not predict HAL 1 year back? That's, I think, broadly his question. And also, why do we intervene only on the SIP day and why not on a more frequent basis? Manoj, I'll pass that on to you as well.
Okay, so I will take, because Muthoot Finance, did you tell Muthoot Finance or somebody wrote in chat?
No, that's another question. That's the next question on Muthoot Finance. But you can definitely. I think he also had a concern on the two gold stocks that we have. So you can maybe cover that as well.
Okay. So let me see. Instead of giving one short answer, let me explain the logic of why we have done what we have done, and then I'll come back to the AI and ML part. See, as I explained earlier, gold is the real currency. Okay, it meets all the criteria of good money. It's a medium of exchange. It has measure of, it can be measured. It has a standard, and value can be stored. And that is the reason why gold is perhaps the best that you can use by way of money. However, and all currencies that we use today, whether it is Indian rupee or Indonesian rupiah or US dollar or the euro, they are all substitute to gold. These currencies, these papers derive value because of fiat, meaning the government says that this is 100 rupees, so we have to accept that that piece of paper is 100 rupees. Tomorrow, government says, I no longer recognize this 2000 rupee note, then that suddenly the 2000 rupee note will become worthless. Okay, earlier, it was on the promise that it would be converted into gold. So you can give your currency note and against that get gold in return. That is what was called as gold standard. But no country respected this. Every country without exception printed excess currency. And as a result, you saw currencies depreciate against the dollar, because again, I can't go into too many details. Most of the currencies were pegged to the dollar, and the dollar was pegged to gold. So the broad agreement was all countries will exercise discipline. So the currency and USD rate will be managed, will be pegged, and the US dollar in return will peg it against the gold. Okay, but every country without exception printed money, including US dollar. So as a result, finally in 1971, this idea was dropped and the currency value and gold value is dealing. Now coming to India, for us, gold prices never went down, simply because we import gold. So if gold prices go up, because the value of the commodity is going up, it will go up for us also. But suppose the gold prices go down internationally, meaning what do we mean by gold prices going down internationally? US dollar is appreciating. Remember, gold and USD are the main currencies. So if we have to measure the dollar's purchasing power, we measure it against gold. If we have to look at gold's purchasing power, we have to measure against dollar. So if we are saying gold prices go down, that means US dollar is appreciating. And since we import and pay in US dollars, ultimately in rupee terms, gold will still be expensive for us. So whether gold falls or goes up in the international market, ultimately when it came to an Indian consumer, it would always go up, either because of increase in gold price or because of depreciation. And that is why for many people in India, gold is safe haven. Gold will always glitter. No risk with gold. Now, unfortunately, the increase in trading spurred by an injection of liquidity killed this concept. Thanks to your futures and options, etc., gold also became one of the items on which you can speculate. So gold prices also started going up, coming down, etc. And today gold is as susceptible to trading losses as any other asset class. As a result, we have not seen gold prices going up despite 2 years of pandemic and more than 6 months of war. Typically, in these scenarios, gold should have shot through the roof. Gold prices peaked around 5,700 rupees per gram for 24 karat gold. But after that, they have slipped. And only after RBI's policy announcement yesterday, there was some uptick in gold. Gold is now hovering around 50,000. That is 5,000 rupees per gram. And therefore, we are no longer bullish on gold anymore. Now, coming to the AI/ML model and our investment in Manappuram and Muthoot. See, the way our model works is that there are multiple criteria that are looked at by the model. It is not humanly possible for us to look at each of these parameters for all the 3,000 odd companies that are under our radar. And that is the reason the algorithm does the job for us. We do not interfere in what the algorithm is picking. We are at heart a tech company and we respect technology. We are completely loyal to our technology. Okay, so the model throws up a few stocks because there is a cutoff criteria that has to be met. Until and unless that criteria is met, the stock will not be part of our portfolio. I mean, it will not even come under our radar. Now, whatever is thrown by the system, we apply human intelligence to that. So, with respect to Manappuram and Muthoot, there were compelling cases of one valuation. Apply human intelligence and see whether we want to exit those stocks at that value. Given our belief in gold picking up because of the crisis that the world was facing, COVID-19 followed by Ukraine-Russia war, if gold prices go up, then Manappuram and Muthoot are our quasi-gold bets. So these stocks were bound to do well. Now, based on what I explained to you, we also understood that gold is not appreciating the way we expected it to. So with gold no longer being a safe haven, we said we will hedge our exposure to gold finance companies. And between Manappuram and Muthoot, again based on fundamentals, we stuck to Muthoot and finally exited Manappuram. Should we have done this a quarter earlier or 2 quarters earlier? Maybe, maybe not. Because as I told you, we do not have any pro or anti bias against any stock. We are clinical about it. But the stock has to meet our criteria and then we apply human intelligence. After all this, we can go wrong. At no point in time have we claimed that every stock we pick will be a winner and every winner will be picked by us. There will be many companies which will do tremendously well but will not be part of our portfolio because they do not meet our criteria. So I hope this explains our approach and model, etc. Ram, if you want to add, you can.
I think you rightly said. Some stocks like the Adani Group companies typically don't meet what we look for. So though they've been winners for many quarters. The other point was about SIP and do we, take decisions only on the SIP day?
Yeah. Okay. So see, we are working 24/7. Okay, but we do not believe in looking at and reacting to markets on a daily basis. So it's not that we are waking up on 6th, taking a decision and going back to sleep. We are observing the markets and there is a lot of research that goes into what we are doing. But we resist the temptation. We resist the temptation of acting on whatever is happening in the market on a day-to-day basis. So there has to be our approach is to look at it periodically. Most of the parameters, as I said, we get the data periodically and therefore the decision will have to be taken periodically. We do not act instinctively. We do not, something has happened. So except for corporate governance cases where we have zero tolerance, we do, or corporate actions where, for example, a company is going for delisting, things of that sort which require immediate action, we resist the temptation to interfere in between. And that is the reason why you get the feeling that we wake up only on the SIP.
I think the SIP is a good way to keep adding in these uncertain times. And we have a model and a platform where even in direct equity stocks, you can do an SIP with our advisory assistance. And every month, these stock quantities are dynamically calculated based on the exposure that you already have. So if a particular stock has not gone up well, you'll get, or the price is lower, you'll buy more units of that stock. The other question was from Vishnu on the same Muthoot and, could we have exited Muthoot or Manappuram? Like Manoj said, we have held on to Muthoot and we've exited Manappuram. Muthoot is a very tightly run ship, and we know many ex-colleagues who work in that NBFC, going back to my NBFC days. And it's a tightly run ship, highly operational efficiency is very high. The return on assets are upwards of 5%, whereas for many banks and other finance companies in regular finance, it will be between 1 to 2%, or maybe below 1 actually for many PSU banks. ROEs continues to be high. Assets, they're expecting a decent AUM growth. And they've tightened the ship, focusing more on credit quality. So we'll watch Muthoot for some more time. And like Manoj said, unfortunately, there is the shadow of gold on this, or the glitter of gold is on this. But believe me, right now the market is negative towards gold, but the day gold picks up, these stocks will run through the roof. That's why our decisions were, we had to make exceptions to the core model as far as this is concerned. A few more questions have come through the chat during the day. This is from Sambaya. Mostly see large and mid cap shares that we've invested. Any idea of small cap portfolio? Sir, we do have a small cap portfolio called SPARK. SPARK is an acronym for Small Cap Algorithmic Research in Key Stocks. And this is about 25 stocks that we have as of now in this portfolio. And one of the slides I showed earlier in this call, it's done pretty well. The numbers are quite decent. It has given about 24% CAGR since June last year, compared to BSE at around 15%. So the portfolio has done well. The interesting thing is that most of the companies in this SPARK portfolio are B2B companies, and therefore they have sticky revenues. They have contracts with customers who tend to be large players or international players. And these companies we pick based on consistent and high return on equity. For example, there's a packaging company. And packaging industry as a whole is doing well because consumption in India is going to do well. So people will buy more stuff as their discretionary rises, and you will see a huge glut of good goods going around, and you need packaging for that. There's a lot of chemical companies in the portfolio as well. So that's how SPARK is an option for you to consider. And you please email me. You have my email ID. I'll anyway type it in the chat here, and you can just type in the email at jamawealth.com. Yeah, we can share more information. The next question is from Sanjeev. Sanjeev, our friend, is asking if we have to pick one scrip in the portfolio, which we believe is the next Bajaj Finance or Titan. Which one will be that, assuming a time frame of 3 to 5 years? Manoj?
We'll let Sanjeev find that out and share it with all of us.
Yeah. Okay. So I mean, Sanjeev and Manoj are friends, so maybe he answered it in a lighter tone. But the official answer, Sanjeev, is that we don't typically bet on one script. The reason why we have a diversified portfolio is to spread risk, diversify. Um, we believe in the axiom that we should not invest more than 10% in one stock, and that applies to most employees with large ESOPs. Unfortunately, many of my ex-Infosys colleagues, I've been telling them about diversification, but it didn't work out for many of them. I wish they diversified earlier. So a portfolio that is balanced regularly. Yeah, I know some people will say, oh, your this churn is high, but see, that's not a bug in the model, it's a feature of the model. And maybe in the next call we'll cover more detail, because it helps us prune exposure to stocks which have really run up. It helps us feed stocks which are underperforming but have good fundamentals. And every stock that has been in our portfolio, there are strong reasons to it. Whether it was even a Manappuram, which in hindsight seems like a wrong decision, but there were some expectations we had on the movement of gold, given the global uncertainty, given post-COVID, given credit uptake, etc. Yeah, we were wrong in those cases. We've been right in many other cases. So diversification is better, sir. Next, one more question from Sambhai. I'm going chronologically. Any plans of starting a PMS? Yes, given our growing, clients like you have been asking us, so we are in the process of applying for a PMS license as well. We'll keep you updated when the PMS, if and when the PMS comes through. Ramu C is asking a question. At this point of time, are the portfolios fully invested or partly into cash? Sir, we typically stay fully invested in the equity portfolios. Whenever the markets give an opportunity to buy, we suggest topping it up. The reason being, we can't predict what will happen in the next 3 months or 6 months, and these are long-term portfolios. So if you're going to stay invested for at least 5 years, it's better to not try and time the market. However, when a new client comes in, or when you start a new plan, an investment plan, we typically stagger it. We stagger it, over 6 or 8 or 10 weeks, depending on the portfolio, the complexity, the risk appetite, etc. Just so that we don't put everything in one shot. We time it that way. But like the saying says, right, the best time to plant a tree was 20 years ago. The next best time is now, right? That's the view. Muthoot, I've answered again. Trinath, we recommended HAL, a public sector company. Being a public sector company, how promising is it, even though it comes under Navratna? Manoj?
Yeah, see, as I said earlier, we do not have any bias towards either favorable or unfavorable towards any company or sector. Although I will concede that we look at public sector little skeptically. Okay, but the criteria of our parameters has to be met. There is no compromise. And if a company is meeting that criteria, and on application of human intelligence, we do not find reasons to reject that company, then it comes in. Otherwise, we will not be true to our model. So HAL meets the criteria, and we didn't find any reason why we should not be investing in that stock. Hopefully it will vindicate us when we meet next.
Yeah, we've seen a steady uptick in the manufacturing focus. There's a lot of emphasis on substituting imports, especially in defense. And the interesting thing is now HAL is actually, instead of going on the back foot, is going on the front foot. We are now we are seeing scenarios where HAL is exporting certain variants of its products to other countries. This was never the case a few years back. So India actually is now becoming a significant player in defense exports. and many of these companies are going to ride that wave, and therefore there is and the world is getting increasingly uncertain, so you can definitely bet on defense for some time at least. um, that's about it. I think last question from Mr. Shastri Garu. Comment on Balkrishna, KPR, and Diviz in our portfolio. They are from different sectors and in negative for a while. Sir, I think the answer is similar to what Manoj answered earlier. Balkrishna is a leader in the high-end tires business with a significant international business, export operation. So it is one of the key, a good beneficiary in the manufacturing boom that we are seeing. Well-run company. Yes, stock price may go up down for some time. We have to be patient. We just can't be knee-jerk in terms of looking at one quarter for exiting that company. Second is KPR. KPR again. Whenever I speak to any textile manufacturer, and I'm going to speak to some more of them in a couple of months when I go to Coimbatore. There's an unprecedented boom in textile manufacturing that we're going to see over the next few years in this country. And KPR is one of the extremely well-run companies with a very high quality of corporate governance. Diviz again is a industry leader. It is in the pharma outsourcing space, a well-run company. So continues to be in the portfolio. So we're not looking at price action per se as an exit point. We are out of time actually. We started at 4:03 and now it is 5:05. But I'll still take one last question that came from Rahul. Please elaborate why IGL, given the recent volatility in crude and macro uncertainty, etc. So if we look at the growth trajectory of IGL that we've seen over the last 1 year and 3 years, it's been the company has done exceedingly well. They've managed to, in spite of the increase, the last 1 to 2 years we've seen tremendous volatility in gold prices, but the company has managed all the volatility well. All the volatility well, and it has the monopoly in the CNG space, liquefied LPG space as well. So our view is that if the company is showing consistent growth, if the ROE is good, if broadly all the key parameters are met, then we will give the company a chance in the portfolio. Yes, this is one of those exceptions where this also happens to be a PSU oriented stock. That's it. Any closing remarks, Manoj, from your side?
No, Ram, I think today we've given more of a macro perspective rather than stock specific, but I feel given the current times, it is better we understand what is happening all over the world, and that will probably help us look at our portfolios and performance a little more differently.
Yeah.
So stay calm, stay invested, be at peace.
I think the theme this time, as you rightly said, was around India and how India compares to other markets, what are the key trends, etc. In the next call, we'll pick 1 or 2 sectors and go deeper into them, maybe technology, for example, or any one of the consumption-oriented sectors, and talk about what we feel about them and why we love a particular sector or love. I mean, no point talking about sectors we wish to avoid. All right. Thank you and have a great weekend. We'll share the recording of this to you and to those who missed the call. Thank you for joining us on a Saturday afternoon, Saturday evening. Bye.
Thank you. Bye-bye.